Welcome to Voich Daily Finance, the most important news personalized for you every day. Supported by Voich.com.
In today's episode, you'll learn about, first, today's US market review. A market rollercoaster as tech stocks surge on rate cut hopes, but a critical inflation report looms. Is this a dovish dream or the calm before a correction storm? Second, the end of greedflation. Price hikes plummet 68%, igniting a retail bloodbath. Which retail giants are now locked in a high-stakes battle for survival, and which companies will be crushed for misreading the consumer? Finally, Nvidia's nightmare. Broadcom stock skyrockets 11% as its secret partnership with Google is revealed to be a high-stakes bet to end Nvidia's dominance. Is this the turning point that dethrones the GPU king? We reveal the little-known chip that's 4 to 6 times cheaper and could trigger a massive power play on Wall Street. Nobody saw this coming. The Federal Reserve has flipped the script with talk of a December rate cut despite inflation running hot. Listen to me. Tech stocks are on a roller coaster and today's economic data could send them flying or tumbling. The S&P 500 is holding at 6,708, but don't be fooled. This calm could break any moment. The Nasdaq has already surged 2.7%, riding the wave of optimism. But I'm telling you, this is a make or break moment. Let's dive into what's fueling this frenzy. The Fed's dovish pivot has sent rate cut probabilities soaring to 79 to 83%. But hold on, Fed Chair. Jerome Powell cautioned that a cut is not a foregone conclusion. The markets are caught in a tug of war, and today's delayed inflation data from the government shutdown will be the deciding factor. The September Producer Price Index, PPI, is out at 8:30 a.m. Eastern, with expectations set at a plus 0.3% month-over-month increase. If this number surprises to the upside, the dream of a December rate cut could crumble, sending tech valuations into a tailspin. The stakes are high, folks. The Fed's potential rate cut is a double-edged sword. On one side, it could reignite growth in tech stocks, which soared on Monday, with Broadcom jumping 11.1% and Alphabet up 6.3%. But let's not forget the other side. Persistent inflation could force the Fed to hold rates, and if the PPI data disappoints, tech could face a harsh reality check. Institutional investors are already shuffling their cards, with trading volumes spiking to 79.75 million shares. The VIX, Wall Street's fear gauge, is ticking upwards, signaling rising anxiety. Here's the strategy. Listen closely. If today's PPI data comes in hotter than expected, cut your exposure to high valuation tech stocks immediately. Rotate into financials and cyclicals where rising rates could be a friend, not a foe. The valuation game is critical here. Tech's lofty multiples could see a swift correction if rate relief is off the table. On the other hand, if the PPI aligns with or is below expectations, it's a green light for selective tech plays, especially in AI and semiconductors. Broadcom, Nvidia, and Tesla are your tickets. Now, let's talk sectors. Technology led the charge with semiconductors and AI infrastructure at the forefront. Broadcom's 11.1% surge and Tesla's 6.8% rally highlight a focused rotation into AI winners. The semiconductor index, SOX, could see further upside if rate cuts are confirmed. But watch out, consumer discretionary took a hit with Abercrombie & Fitch down 6%, reflecting consumer spending jitters. This divergence signals a critical rotation pattern. Investors are betting on tech's durability over consumer whims. Good advice makes you rich. Bad advice costs you a fortune. Listen to me. Here's your playbook. Short term, if the PPI exceeds plus 0.3%, act now. Reduce tech exposure by 20%, targeting RK and high P divided by E-tech stocks. Rotate 3 to 5% into financials, XLF, and cyclicals, XLI, as a hedge against rate hold scenarios. Medium term, if the December rate cut gets the nod, overweight semiconductors by 5 to 10%, look at NVDA and AMD, with targets at $450 and $120 respectively. But here's your defensive move. If inflation persists and rate cuts stall, increase cash holdings to 15% and allocate 2 to 3% into gold, GLD, as a hedge. Watch these critical levels. If the S&P 500 breaks 6,600 on inflation fears, brace for turbulence. For hedging, advanced investors should consider selling call options on tech holdings and using the premium to buy protective puts. Intermediate players can rotate into defensive ETFs like XLU, utilities, and XLP, consumer staples. For basic investors, maintain a cash buffer and avoid high beta names until clarity emerges. Time's ticking. The PPI data will set the tone, and the Fed's next move could reshape the market landscape. Follow this framework and you won't lose. Now let's examine today's key news stories. Let's start with a single statistic that might just change your entire perspective on this company, or rather the entire retail sector. The number of global companies announcing tariff-related price hikes just fell off a cliff. At the start of the year, nearly 90 major companies were raising prices. By the second quarter, that number was 51. Today, it's just 28. That's a staggering 68% drop in companies passing costs to you. We previously analysed how tariff chatter on earnings calls was surging. This latest development is a sharp reversal as the tariff fog clears. So the thing is, analysts track these earnings calls using sophisticated analysis. And these mentions of price hikes are what economists call a leading indicator. They give us a peek into the future. The fact that they are collapsing this fast suggests that corporate pricing power is crumbling. This is a direct challenge to the idea that interest rates will stay higher for longer, and it could cause a major shift in the bond markets. This isn't just a sign that costs are disappearing, though. It's a sign that a high-stakes war for the consumer wallet has just begun. While companies initially flagged over $35 billion in costs from US tariffs, they're now facing a new fear, losing sales to cash-strapped consumers. Retail giants are making their move. Walmart is absorbing tariff costs and focusing on price cuts. Target is slashing prices on over 3,000 everyday items. A while back, we noted that value leaders were pulling in shoppers across income brackets, with 75% of Walmart's gains coming from households earning over $100,000. Today's aggressive cuts are Target's direct response to that pressure. Now, what's really driving these aggressive moves is a severe split in consumer health that's hiding in plain sight. Recent data shows that while higher income households are still spending strongly, lower income households are facing serious pressure. With their spending growth slowing down, this is what's called a bifurcation. A while back, we flagged the canary in the coal mine. Youth unemployment jumped to 12.5%, and fast casual chains like Chipotle reported fewer visits from 25 to 35-year-olds, early signs that younger and lower income cohorts were tightening belts. So, while total spending numbers might look okay, they're masking a recession-like environment for a huge portion of the population. Walmart and Target see this clearly, and they are fighting to win over these increasingly price-sensitive customers. But that's not the whole picture. The real turning point is the brutal battle erupting between competitors. Take Newell Brands, the seller of Mr. Coffee. Its CEO admitted that after they raised prices, their competitors did not follow. The result? In his own words, the move positioned them as uncompetitive. It's a stark warning to anyone who makes the wrong call. Believe it or not, this signals the end of an era. For the past few years, during what some call greedflation, it felt like all companies could raise prices together and customers would just pay. That's over. What we're seeing now is the return of market discipline. When Newell Brands raised prices, its competitors saw an opportunity to steal market share by holding their prices steady. This reintroduces a powerful deflationary pressure into the system. As we discussed a while back, the exception will be brands with deep equity and affluent customers like Coach or Ralph Lauren that have been able to hold pricing. Everyone else is back to fighting on value. This all begs the question, what's the real end game here? The situation presents a fascinating duality. On one side, companies are facing rising costs, while on the other, they're terrified of losing a consumer they can't afford to alienate. The CEO of footwear company Deckers Brands warns they are anticipating a more cautious consumer as the full impact of tariffs and price increases will be felt here in the US. Many companies are now holding off on major price hikes, absorbing the impact themselves or pushing the burden onto their suppliers. However, if you zoom out, you'll see another layer of strategy at play. Actually, the global supply map has been completely redrawn. For instance, China's share of US imports has fallen dramatically from over 21% in 2017 to under 14% recently, with countries like Mexico and Vietnam picking up that share. For Chinese-speaking audiences, this is a critical point. This trend implies that new tariffs are now a bigger threat to corporate profit margins and China's export share than they are to American consumer prices. Companies are waiting for clarity, afraid to make a move that could cost them market share. This wait-and-see approach has a hidden danger. It's not just about pricing. This hesitation is likely causing a broader pause in business investment, things like building new factories or stocking up on inventory. That kind of investment paralysis can create a self-fulfilling economic slowdown. In other words, the economy could hit an air pocket simply because everyone is waiting. A key thing to watch will be business investment data, like the ISM New Orders Index, to see if this slowdown is already happening. The battle over tariffs is no longer just about who pays the bill. It's about which companies are willing to sacrifice profits to win the cautious consumer and which will be left behind for misreading the market. We were just talking about companies getting squeezed on profits in the brutal retail landscape. Now, let's shift our focus to a corner of the market where profits are absolutely exploding, revealing a new challenger in the high-stakes AI chip wars. A chip maker just saw its stock rocket over 11% in a single day, capping a staggering 60% rally for the year. That company is Broadcom, and the reason for the surge reveals a massive power shift happening right under Wall Street's nose. While the market has been obsessed with Nvidia, the real story is Broadcom's deep, long-standing partnership with Google parent Alphabet. For years, Broadcom has been the secret weapon helping design and manufacture Google's in-house artificial intelligence chips, the tensor processing units, or TPUs. A while back, we broke down how leading labs were adopting TPUs as a true second architecture alongside Nvidia. The latest development is that Broadcom is the quiet engine behind that playbook. Here's where it gets interesting. These TPUs are a type of chip called an ASIC, or application, specific integrated circuit. As we've discussed before, this is a big deal. Unlike Nvidia's general purpose GPUs, which are like a Swiss Army knife for computing, ASICs are custom built for one specific job. In this case, that job is running Google's AI models with maximum efficiency. These aren't just any chips, they are now considered a direct competitor to Nvidia's dominant GPUs. Now get this, the cost difference is staggering. After all, by designing its own chips with Broadcom, Google can bypass the massive markups on third-party hardware. Some analysis suggests Nvidia's gross margins on its high-end chips are in the 80% range. By comparison, Google might be getting its AI compute power for as little as 20% of the cost. This points to a potential 4 to 6 times cost efficiency advantage at the hardware level, which is a massive deal. This increased competition could eventually create a deflationary trend in AI compute costs, making powerful AI more accessible. And the partnership is hitting what one top analyst calls an inflection point. The numbers are jaw-dropping. In April, Google's AI was processing 480 trillion tokens of information. By October, that number exploded to 1,300 trillion. This is the tangible momentum that has analysts racing to upgrade their targets, with some forecasting another 41% upside for Broadcom stock. What really brought this to a head was the next development. This isn't just a Google story. It's a sign of a much bigger shift in the entire AI capital spending cycle. We previously called this the AI capital expenditure supercycle, where the scale of spending becomes its own economic force. The latest data shows worldwide data center capital expenditure surged 43% year over year, driven by a massive 76% jump in spending on accelerated servers, which includes both Nvidia's platforms and these custom chips. Remember those projections that data centers could approach a tenth of US electricity consumption by 2030? That demand pressure can even become a new source of inflation. This diversification is crucial because unlike the dot-com bubble, which was built on one thing, fiber optic cable, today's AI boom is being built on a varied mix of hardware. This suggests the investment cycle is far more resilient. The core conflict is now crystal clear. It's a battle for AI supremacy, and a new challenger has entered the main stage. As one global tech researcher at Wedbush Securities put it, Broadcom and Alphabet are the new AI plays the market is rediscovering. He calls the Google TPU, built with Broadcom, potentially the most proven ASIC chip in the market. This isn't just a stock story. It's the story of a new front opening in the AI chip wars. It signals that the battle for the future of computing is far from over. But there's another angle to watch here. This deep partnership between Google and Broadcom is a classic case of what economists call vertical integration. While it's a powerful strategy to challenge Nvidia's dominance right now, it could also attract unwanted attention from regulators down the line. Regulators are concerned that tech giants could use their custom hardware to create walled gardens, making it harder for customers to switch and thus stifling competition. We've also highlighted how this is spurring sovereign AI responses. Think Europe floating AI gigafactory plans, which could intensify the policy spotlight. It's an ongoing focal point to watch as this new front in the AI chip wars develops.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.